Consolidation of entity. Accounting section of CFO100. The consolidation of entities is one of the main issues in accounting. This topic is not only related to the standalone entity level, but also to the group level. You need to understand once again the difference of impact based on each consolidation methodology to control your group structure of consolidation and recognition of profit and loss. The role of CFO is not only managing one entity, but also optimization of the group. When you consider the consolidation of entities, the first and the most important point is the categorization of each type of entity. You look at the table on this slide. It shows the overview of categorization. You can see categories from subsidiary to other investment in this table. If you are an accounting professional or finance professional, you already understand the basic threshold for categorization. But you may have many occasions to explain those points to your business divisions. And your accounting team and the business support team need to properly explain the mechanism to business division. Getting into detail of it, 50% threshold and 20% threshold are the most remarkable points to determine the categorization. More than 50% of the share percentage is generally categorized as subsidiary. Between 20% and 50%, those entities are categorized as affiliates. On the other hand, there is a case that under 20% share is categorized as other investment. However, this categorization doesn't depend not only on share percentage, but also on the concept of control and the significant influence. In fact, those two concepts are the real factor to determine the category. When you give the instruction to business division, you should emphasize this point of view correctly, otherwise business division remember only percentage. Control and significant influence are determined by some factors. For example, how many number of directors are assigned by your company and how many directors are assigned by the other shareholders. In addition to that, the content of SHA is also important because the matters in which your company has a right to have influence determine how much you have control and a significant influence to the entity. This fact means that there are cases that our entity is categorized as affiliates, though the share percentage is over 50%. At the same manner, even if it is under 20%, it is sometimes categorized as affiliates. When it comes to talking about non-consolidation, it is also confusing points for business division. Accounting division should give the proper explanation about it. You can see non-consolidated subsidiary and non-consolidated affiliates. Even though the share percentage match the threshold, there is a case that the size of the investment is a negligible and small amount from your group perspective. It can be recognized as non-consolidated subsidiary or non-consolidated affiliates. The size of amount as threshold to determine the non-consolidation depends on the group size. So, You need to discuss with your auditor if your group doesn't have such a rule to determine the group's accounting policy. Although accounting division or the other related professionals have clear knowledge of categorization, the lack of the understanding by business division causes an unexpected consequence of treatment of consolidation. For example, business division assume that the new project will contribute to group's profit or loss, but it is not consolidated as group's net income due to lower percentage of share or size of investment. It is impossible to change the categorization after determining it at the first time. That is why it is important for accounting team to give the proper instruction to business division to let them consider and negotiate for new investments with the proper understanding of the consolidation rule. Once you understand again the categorization of consolidation of entities, you also should understand how each entity's earnings should be recognized in consolidation. Each category has a characteristic way of consolidating earnings. This page describes the way of it. There are the different rules for subsidiary, affiliates, and other investment. First of all, the recognition of earnings for subsidiary is conducted as full-line consolidation. It means that subsidiary's revenue, cost, and all other line items are aggregated on its shareholders once. Capital gain by selling the share is recognized as an impact on net income. On the other hand, affiliates and JV's earnings are based on equity pickup method. It means that the recognition of earnings is calculated as net income of the entity multiplied by your group share percentage. And also, capital gain should have an impact to group's net income. As the most tricky recognition, other investment should be generally categorized as FVTOCI, and you recognize the consolidated earnings only in timing of dividend from the entity to shareholders. It means that the profit of the entity has no impact to your group's consolidated profit and loss if this type of entity doesn't pay dividend to shareholders. In addition to that, you must understand and correctly share the information that capital gain caused by this type of company is not recognized as net income of your group. This is a very unique point which many people have mistakes. After understanding all those basic points of recognition of earnings, you should look at the same point regarding a non-consolidated subsidiary and non-consolidated affiliates JV. Those earnings are recognized in the same manner as FVTOCI. Only the recognition of capital gain has its difference. From this perspective, the way to recognize earnings seems not so simple and it is a confusing topic. You must have experienced that your business division conducts negotiation about share percentage with potential business partner and the investment amount. Then they realize that such investment doesn't have its impact on your net income as group basis. This unexpected fact has an expected impact in business development and asset management. It is true that there is contribution by the investment to the group even without recognition of net income, but OCI is sometimes regarded out of group's KPI, and also announcement to public market is usually based on net income, excluding OCI. When it comes to talking about much administrative issues, people frequently make mistakes for consolidation of subsidiary, and it causes the trouble of consolidation work in your group. So, such type of work should be handled by people having enough knowledge and experience. In addition to that, the rule of recognition of earnings is often out of business division's mind. The instruction is needed to be properly announced to business division, and the explanation material should be prepared and shared with them. In reality, business division are not always remembering the past practice and not always involved in development of new projects. So this type of knowledge can be easily out of their mind. Your accounting team should give proper guide for business division. By doing so, business division can proceed negotiation with potential business partner and discuss in negotiation with understanding the expected consequence. In this slide, you can understand more about FVT OCI and FVT PL. Those two categories are very unique and people usually have misunderstandings. Your accounting division or business support division receives questions related to this topic from business division when the division is considering a new investment. So, CFO should understand what type of difference between them and some practical strategic ways to use this categorization for your group. This table is good for you to catch the overview of the characteristic points for those two categories. First of all, FVTOCI is used to hold the share for non-trading aims. The recognition the difference of value between fair value and book value at the end of the fiscal year should be done and has an impact on OCI. And also, when you sell off the share, the capital gain has the impact to profit and loss as OCI as well. On the other hand, you have FVTPL. The categorization is for the shares to hold it for trading purpose and to pursue capital gain. Difference between fair value and book value is recognized as net income at the timing of end of fiscal year. Capital gain also had the impact to your group's net income. Overall, FVTOCI is much conservative recognition way, because even in the timing of impairment of the investment, you don't need to recognize that loss as net income. You can segregate that amount to OCI. On the other hand, FVTPL is an aggressive approach, because if the fair value of the share is down, it causes a loss of net income. This type of categorization is used for the share aiming for IPO and selling out for capital gain. Without recognizing the impact as net income, it is deviated from the original purpose of having that type of share. To understand the specific situation when you need a strategic decision, there is an example. At the beginning of an investment, you just inject a small amount of money for a minor share below 20%. But looking at the growth of the company, you want to inject much money and the share percentage is increased to over 20%. Until that time, if you recognize this share as FVTOCI, even if the worst case of scenario happens and the investment of the share has impaired, you don't have to recognize the impact as net income. By doing so, you can control the risk of impact on your financials. There is another example to see how this categorization is related to decision making. Business divisions sometimes want to recognize capital gain as net income when it sells off a minor share of a startup business, because it is the main purpose to hold the share. However, business divisions usually don't have comprehensive knowledge about categorization between FVTOCI and FVTPL. They don't realize the idea of FVTPL. You should give the proper announcement and explanation to this business division by telling that they can utilize the categorization of FVTPL instead of FVTOCI. Consolidation of entity is a fully accounting thing, but the complexity of this matter causes a lot of confusion among business divisions. CFO should make an accounting team prepare clear instruction materials and the explanation. The important point is that it is not possible to change the categorization without any significant real movement. That's why this is the key point at the beginning of the investment. As CFO, it is important to control the group's financials properly. The categorization of entity is the starting point of it. You should think about it from a strategic perspective with considering how the categorization has an impact on the visual of your financials. Even though the fact is the same, the financial result shows a different view if you mistakenly handle the matter. In this lecture, we didn't get into details of the concept of control and the significant influence. But this concept is important to think the marginal and the sensitive situation to evaluate the categorization of entity. You can learn it in another lecture.